Good morning friends, how are you? Welcome to The Point. In this video we will discuss two types of indirect taxation, that is the current taxation system of the country, that is goods and service tax, and the predecessor of goods and service tax, that is value added tax. So for you it is very important to understand that for any economy taxation is a very important source of income. Why? Because of this income only government is able to run its subsidy scheme, do welfare for its citizens of the country. For an example, if you say or consider, if you go to a government hospital, you will always find fees or the charges lesser than the private hospital. And how is that possible? How is the government able to provide services at a lesser cost to the citizen of its country? It is because of the taxation or the tax that it collects as a source of income. Due to it is because of this it is able to provide the services at a lesser cost or at a subsidized cost to the citizen of its country. Now, starting off with value added tax, what is it all about? What are the limitations of it that led to the government to launch goods and service tax regime in the country? So first we'll take up what is value added tax. Value added tax is an indirect tax which was introduced into Indian taxation system on 1st April 2005. And when was GST introduced? Come on, you have to think. I'll give you 10 seconds. Okay, so it was introduced in 2016. This is something you have to really remember. You don't have to, this should come like very promptly, and that you don't need to put in efforts that oh it was 2016 or 17. No, it is bang on 2016. Value added tax was 2005. Value added tax is a consumption tax levied on the commodity whenever value is added to the product at a point in the supply chain. So this is supply chain, as you know. So the product goes from a factory owner to the wholesaler, then to the retailer, and then to the consumer. So in this supply chain, if the value is added to the product, so value added tax is the tax that would be levied on it. For an example, if a person is a manufacturer of sugar, now is converting sugarcane into sugar, so which means it is adding value to the sugarcane. So at this point, when this factory owner will sell sugar to the wholesaler, since value has been added to it, this factory owner will charge value added tax on the sugar sold. Now this wholesaler is what this person is doing. It is refining the sugar or converting the sugar into refined sugar. Again, some value is added to the sugar that was bought from the factory owner. So again, when this wholesaler will sell it to the retailer, this wholesaler will charge value added tax on the sales made. Now this retailer, what this retailer is doing, since this retailer has got this refined sugar in jute bags, now what this retailer is doing is packing this sugar into very beautiful cardboard boxes or some paper boxes, which is again adding value to the sugar, not actually sugar but the whole product. So when this retailer will sell that sugar in the market to the end consumer, will charge VAT on the final product. So value added, as the name suggests, value added tax is the tax that is levied on the value added in the product in the whole supply chain. VAT was introduced to replace the sales tax in the states, but in case of interstate supplies, central sales tax was imposed. So what was the case under value added tax regime? So there are two types of sales. First is intrastate and the other is inter. As the name suggests, in case of inter, it is that is from one state to the another. For example, from Maharashtra to Rajasthan, from Delhi to Kerala. So any two states, that is interstate. Intra is within the state. So whenever within a state a supply is happening, so value added tax was levied. But in the case of interstate sales, it was central sales tax, that is CST, that was applicable. Now what were the limitations of value added tax that led to the government GST? So the first one was VAT paid on input. No, it should be service tax paid on services cannot be adjusted for VAT paid on goods paid on services. So on services, service tax is levied, and on goods it is VAT that is paid. So if you're paying service tax on services, that cannot be adjusted for VAT paid on goods. This I'll explain you later at the end of the video through a proper example. But as of now, what you have to remember is, under VAT regime, service tax paid on the services is not adjusted for the VAT paid on goods. Next thing, calculation of value added at each state is a tedious process. Yes, certainly it is, because it is very difficult to calculate or keep calculating how much value is added when sugarcane is converted into sugar, or when sugar is converted into refined sugar. This is just for an example. There are thousands and zillions of product that is being produced in the country, and it becomes very difficult for the taxing or assessing authority to calculate as to how much input or how much value is added at each stage of production. So that becomes the limitation of VAT regime. Next is, in the case of VAT, so there was different VAT laws for every state. Since there was different VAT laws, there was different VAT rates that was prevailing. So there was no one uniform tax rate or tax regime system that was applicable throughout the territory of the country, because in case of interstate, it was central sales tax that was applicable. In case of intrastate, it was VAT that was applicable, and that to every state having its own VAT rates because of the different VAT laws. So that again became one of the disadvantages of VAT. So all of this was tried to be removed by the new system, that is goods and service tax, and to an extent it has been successful. How? We will study really. Now, what is goods and service tax? Goods and service tax is an indirect tax. Again, like VAT was an indirect tax, it is again an indirect tax levied on the supply of goods and services. Earlier on services it was service tax, but now there's one integrated tax, that is goods and service tax on supply of both goods and services. This law has replaced many indirect tax that existed earlier in the country, like central sales tax, service tax, excise duty. It is a multi-stage, comprehensive, destination-based tax. Now this point is very important, that what is destination-based tax? For example, goods are being manufactured in Maharashtra and they are supplied to Rajasthan. Now, since it is destination based tax, so it is the Rajasthan government who has the right to levy and collect tax on the goods supplied from Maharashtra. Earlier what was happening was, when under the VAT regime the goods were manufactured in Maharashtra, so Maharashtra government used to levy excise duty, okay, and then there was central sales tax that was applicable. Now since this GST is destination based tax, Rajasthan government, which is the receiver of the good or the consumer or the destination of the goods, so this government will actually apply or levy and will also collect the taxes. So it is a destination based tax that is levied on every value addition and is one indirect tax on whole of India, that is single integrated taxation system. It is single tax on supply of goods and services right from manufacturer to the consumer. So there are no different sort of taxes, because earlier in the case of VAT regime, manufacturers used to pay excise duty and not VAT, and the consumers used to pay VAT. So there were two different types of taxes, but now there is only one tax. Even if you are a manufacturer or a consumer or a retailer or a wholesaler, one tax, that is GST. Credit of input taxes paid at each stage will be available in the subsequent stage of value addition, which makes GST essentially a tax only on value addition at each stage. The final consumer will thus bear only the GST charged by the last dealer in the supply chain, thus eliminating the cascading effect. Now I have taken a separate video as to what effect is. I will reiterate right now that cascading effect is that whenever tax is levied over tax, that is the compounding effect that takes place. Now for an example, you are into some manufacturing process, okay, and you are getting goods rupees 100 for that's the raw material for your production process. On this 100, tax is levied of 10, so total cost to you is 110, but out of that 100 rupees is for the raw material, and this 10 is taxation. Okay, now when you're selling this product, now that is 110 is your manufacturing cost or the cost of raw material. Now you're adding 30 rupees margin to it and adding some value, due to which you have added 30 rupees profit. Now you are selling it at 140. Now on this 140 you are levying a tax at the rate 10%, okay, which comes to rupees 14. So 140 plus 14 is 154. Now this 154 has two elements. So 140 is the price of the product and 14 is the tax. Now if you're seeing, when you're levying 10% on this 140, it also includes 10 rupees that you actually paid here as a tax. So this 10% also includes tax on tax, that is that 10 which got included here. So this 10% you are levying it on here. So this is tax on tax. This 10% charge is on the total 110 rupees, whereas the ideal case should be that this 10% should be levied on 100, which is the cost of raw material, plus the profit margin, that is the 130, and it should not be 140, because this 140 also includes the 10 rupees that you have paid on tax. But in case of GST, what you can do is, whatever tax you are collecting, since you sold the product and 14 rupees came as the tax collection, so while paying off the final tax to the government, you can reduce the tax paid at the previous stage. So the tax that you paid at the previous stage is rupees 10, so the collection is 10 and paid is what, 10 rupees. So to the government you will pay just rupees 4, because 14 you collected, 10 you paid at the previous stage. So this is the final amount. So you are eliminating the cascading effect in case of GST. So this is one of the major benefit of goods and service tax. Moving on to the next slide, which considers the advantages of goods and service tax. First is it eliminates cascading effect, as I've explained you perfectly through an example, how that 14 rupees, 10 rupees that you paid, to only you are paying tax on the value addition and not the tax that you paid at the previous stage. Next, credit for input services can now be set off for tax paid on goods. We'll take this in the upcoming slide. I'll explain you the example how VAT regime didn't allow this and how GST regime allows this. Lesser compliance, it's easier to there's less number of returns or books that you have to maintain in the GST regime as compared to VAT, and since lesser books you have to maintain, it makes the procedure simpler while you file the returns. And the last point is, there's one uniform tax rate throughout the country. There are not multiple tax rates prevailing in the different states. One single uniform or unified tax rate applicable in the entire country. So last slide talks about the example. So we'll take, so there's one consultant who's providing services to a consumer. So services, the cost of services is rupees 70,000. okay, the cost of services that it provided to the consumer is 70,000. On that 15% service tax is levied. So the tax amount that comes is 10,500. Fine, that is the tax collection. While providing services by this consultant used some goods, that is some stationery, some paper, or collectively called as stationery. So when this consultant bought stationery for its office, it paid, that is for 25,000, it paid 5% as VAT on that. So of 5% of 25,000, it comes to rupees 1250. So this 10,500 was the collection of tax, right? But service tax. Also at the same time, it paid 1250 as tax. Now this is something, the outflow, but this was VAT. Now in case of VAT regime, while paying the final tax to the government, this VAT paid cannot be set off against the service tax collected. That is, you can't deduct 1250 from 10,500 and pay the balance amount. You have to pay this separately. Okay, and this separately. But in case of GST, what is happening is, since there is only one tax, there is no different service tax and there's excise and there's manufacturing tax, just one tax. So on the services that you provided, you collected a tax of 12,600 by the rate of 18%. Now whatever GST you paid on the office supply, that is 5%, right, of 25,000, that is 1250. Now 12,600 is what you collected minus whatever you paid. The amount comes as 11,350. This is the balance amount that you have to deposit with the government, and not that separately 12,600 and 1250. No, because this amount can be set off from the tax paid on the services. So this is one of the major benefit of goods and service tax, that the taxes collected or paid on services can be set off with the taxes paid or collected on goods. So friends, I hope it is clear to you as to what VAT regime was, what were the major disadvantages. That is the first, that there was no uniform tax rate system or uniform tax rate applicable throughout the country, and second, that service tax could not be set off for the VAT paid. That was overcome by GST system, that the tax paid on services can be set off with the tax paid on goods. So friends, with this example, I hope it is very clear to you what and how the calculation was done under VAT system and how it was calculated under GST system. Though you don't need to know how exact calculation was done, this was just for your better understanding that I have quoted one example. So friend, just please revise this example once again, so to bring better clarity in your understanding. Friends, this is all for the today's video. Stay fit, stay at home, and don't go out unnecessary unless it is too much important for you to move out of the house, because prevention is always and always better than the cure. Thank you so much.